Hi everyone, back to example number 2 for the evening. We are going to be talking about two different things here in one. So we've already covered the previous example. Here we are simply looking for two different calculations. I only have so big of a board, so I've separated them by this thin blue line. First, we're going to calculate gross profit. And then secondly, we're going to calculate the value of ending inventory. So again, for those of you that can't see the board all that well, these ones I don't have them written down below. They are in your textbook. I'm literally using number 14 on page 114 and 115 for all your pieces of information. And there is a lot of information on this one. This one looks horrible. It looks really difficult. And I think after I walk you through it, it'll look a lot less frightening, hopefully. So again, these are two separate things and you need to keep them completely separate. One will change the other, but one has nothing to do with the answer of the other. So the very first thing we're going to do is read through the problem. And again, all this data comes from 114, page 114 and 115, problem number 14. This is exactly similar to what I'm going to give you for homework. So I need you to watch the video and I need you to work through the problems. So the very first thing, I'm going to read it. It says gross profit and ending inventory. Convex Mechanical Supplies produces a product with the following costs as of July 1st, 2012. Material, $6. Labor, $4. Overhead, $2. They give you this. It means that all that is added up to $12. Beginning inventory at these costs on July 1st was 5,000 units. From July 1st to December, Convex produced 15,000 units. This is important for your subtraction up above. These units had a material cost of $10 per unit. The cost for labor and overhead were the same. So this changes here from old to new, and we'll talk about that when we get into the calculation. Assuming that Convex sold 17,000 units during the last 6 months of the year at $20 each, what would the gross profit be? And then 2 is what is the value of the ending inventory? So again, this looks really overwhelming because there's a lot of pieces of information, and this is just my printout from page 114. So, gross profit, as you recall, is simply sales minus cost of goods sold equals gross profit. I am not, pay particular attention to that, I am not asking you for gross profit margin, which would be the percent. So don't convert this into a percent. We're just simply talking about the basic subtraction off of your income statement. The very first thing you should have is sales or revenues minus cost of goods sold equals profit, gross profit. That is it. That's all we're asking for here. But you have to take the pieces of information given to you and compute this, because now we've talked about how your cost of goods is broken into two different numbers. It will be one number on your income statement, but to get that number, we really have to compute your old cost of goods sold as well as your new cost of goods sold. So I've done that in red, and then my permanent numbers I have put in blue. Again, ignore the green down below because that is for later, for the second portion of it to calculate my ending inventory, but it has nothing to do with gross profit. So gross profit, I have sales equals 340,000. Where did I get that number? It tells you you sold 17,000 units at $20 per. So 17,000 times 20 equals 340,000. That number stays the same. Then we take our cost of goods sold and split it into two sections. It tells us in the problem right here, beginning inventory at these costs on July 1st was 5,000 units. So 5,000 times 12, where did I get 12? Again, I just showed you, they give you this at these costs above here is $12. So just multiply it across. 5,000 at cost of $12 per equals 60,000. This is your old, this is what you had on hand already. So the new ones, we're going to have, it says that well, it doesn't tell you that we did 12,000, but it tells you you had 17,000 sales and your old cost of goods sold, or how many you had on hand, were 5,000. So 17,000 minus 5,000 equals 12,000 left. Where do we get the 16? Well, it says in your problem, it says these units had, for the new ones, Convex produced 15,000 units. These new units had a material cost of $10 per unit. So if you look at, again, their old book material cost was $6. So you have to swap that out and put $10 in there. So if you add $4 more, 4 plus 12 equals 16. So we have 12,000 new multiplied by $16 cost gives you 192,000. So 60 for the old, 192 for the new, gives us a total cost of goods for 252,000. So again, back to the basic subtraction in your income statement, revenues or sales in this case, minus your cost of goods sold equals your gross profit. That is it. Again, the only hard part of this is figuring out how many they had for the beginning. They tell you that number. They tell you the cost of how much they had at the beginning. So calculate that across. This needs a subtraction here because you had 17,000 total minus the 5,000 that were already there. And then you need an addition into your cost because it tells you the material for this has changed while the other two numbers stayed the same. So again, you just need to know what goes into your materials, but they should tell you that. They'll always tell you that. You don't have to guess that. So they give you all these pieces of information for your sales minus your cost of goods equals your gross profit. Done with that section. All right, for the second part, cost of goods sold is what I sold, right back to accounting 202. That is what physically left, what we've sold. What's left is our ending inventory. So here in this case scenario, we had beginning inventory of 5,000 and it cost $12, right? 5,000 times 12 is 60,000. So we know that our inventory that sat on the floor before was worth $60,000. We produced, total production was 15,000, because again, we only had 5,000 originally, and we sold so many. So we only had 5,000 originally. So we produced, it says in the problem, we produced 15,000 at $16 per. So if you do the total production, that is, or should be 240,000. So this is an addition, right? Because if we had beginning inventory and then we made more inventory, we would add to that. So it's 60,000 plus 240,000. I want you to think of it as physical. I mean, if you were literally in a manufacturing facility and you already had units or whatever you produce out on the floor, and then you made more, you would just be adding to the pile that you have there, or adding to the pallets and the boxes that you already have there. So that's all this is in a visual way, is the original amount that you had there, $60,000, and then you made 15,000 more at $16, which is 240,000. So add 60,000 plus 240,000 should give you a total inventory for sale of 300,000, right? 240 and 60. So that's where you get the 300,000. And then our cost of goods sold, we calculated that up here, right? 252,000 is our cost of goods sold. So take the 300,000, subtract the 252,000 cost of goods sold. So you had, this was, if you remember it from our FIFO, LIFO, and average examples, this was the cost of goods available for sale, is at 300,000, and to subtract your cost of goods sold, which is 252, gives you an ending inventory of 48. So none of this particularly is new. We're just adding in different ways for you to calculate it and look at it differently. You were taught beginning inventory, because I always gave you that up above in your tables to calculate your FIFO, LIFO, or your average. You were always given a cost of goods available for sale after you calculated the top portion. And then we calculated cost of goods sold, subtracted that from the cost of goods available for sale, and you got your ending inventory. So this is just a little shifting in a different way, same information, just a little bit of different presentation. So those are both of them completely separate, but one depends on the other's number. So again, back to gross profit, just to recap, gross profit is simply the sales that they give you, 340,000 here. Cost of goods sold, we're adding the old and the new, which comes to 252,000. So subtract 252 from 340, gives you 88. That's your gross profit. We don't have to worry about this stuff down below for that answer. That is gross profit. For your ending inventory, we take our beginning inventory that we would have up here anyway, 60,000. You'd have your total production, the numbers that they give you in the textbook. They told you that you produced 15,000, and they told you that it cost $4 more for that material. So you have to add that in. Multiply it, it's 240,000. 240,000 new inventory added to the old inventory. 240 plus 60 equals 300. So the $300,000 is your total inventory for sale, or your cost of goods available for sale. Subtract the cost of goods sold that we calculated up here, just 252. So it's just an addition and a subtraction, gives you your ending inventory. I don't know if you can see the ending inventory that clear, so I'll pull it down just a little bit, but that is all that it is. It looks like a lot, but it's not. Gross profit, ending inventory. Any questions on it? I'll be online Monday and Wednesday, so let me know. Thanks, guys.